What's going on in technology? As we previously reported, the tech industry is down more than 7%, and the Nasdaq is down more than 5% this week, its lowest week in almost 18 months. What is the status of that trade? In my opinion, tech made its hand known last week when Nvidia's stock dropped despite a strong earnings report. Stocks falling on positive news are either an indication of a crowded market or a warning sign of impending trouble. This week, tech stocks have been the most negatively impacted. Because tech is a significant holding, consumers may seek to reduce their risk, which could contribute to this decline. There might be a political component to this as well. This week, Trump's chances of winning rose in polls and betting markets. He is perceived by investors as being tough on China, which might hurt semiconductor stocks. Fears that Trump's ascent may harm semis may therefore be a contributing factor in this. What if these stocks currently have too much priced into them? Even if they are excellent stocks, valuations have become a bit too high. Perhaps the multiples are simply illogical. That is conceivable. There have been over 830% drawdowns in Nvidia's last 10 years of existence. In actuality, Nvidia's forward PE was greater during those drawdowns. Since Nvidia's forward PE is currently in the mid-20s, this appears to be typical profit-taking. In 2 years, Nvidia's price decrease to the $90 level will seem like a gift. Are you a buyer on the drop when you consider all of these stocks? Are you suggesting that to others? That moment is drawing near. We projected a 7 to 10% decline from now to November. Since we're already down roughly 5%, the full correction may be brought forward into September by next week. We're closed there if the SP reaches 5400535050, but I wouldn't be a seller here. Was the change from August 5th to September 5th appropriate in your opinion or excessive? It's difficult to say. The VIX spiked to 66, indicating that there was panic, which led to the 3-day drop. However, we also know that a significant amount of money was used in August when it was on the sidelines. The liquidity shift that was connected to the yen had a part in this, and it's happening once more. Stocks have been under pressure as the yen has strengthened. Is it reasonable to argue that the market should be compensated 21 times earnings? That is the valuation as of right now. Is it reasonable, or may it be exaggerated? Given that the 10-year Treasury yield is 3.7% and the typical SP stock is trading at 16 times forward earnings, it seems reasonable to me. You are paying a 30 PE when you purchase a bond at that rate. For 16 times earnings, you can purchase stocks that are increasing by 10%. In my opinion, equities are a great deal right now, particularly since inflation is declining and interest rates are being lowered. Are you talking about the 493 stocks that aren't in the Mag 7 when you suggest that stocks are a bargain? Indeed. The Fed is on an easing cycle, which makes the 493 appealing. For instance, the Russell 2000 small cap stocks offer a significant margin of safety with a median P of 10 times earnings. Although I don't think tech is a sell here. If individuals are worried about seasonality, it could be a source of funding. Do I believe that by the end of the year, the Mag 7 will be lower? No, I believe they will be higher. But it's difficult to predict when the bottom will be reached. The issue is that, while technology is readjusting, the economic uncertainties may make you uneasy about venturing into other fields. How do you strike a balance between that? Investors are faced with the dilemma of whether to purchase tech during the decline or whether the re-rating will continue. The growth rates are slower than they used to be, but they are still fantastic. And if there are concerns about the economy, can you trust the other sectors? The tight and steady credit spreads indicate that growth concerns are more narrative in nature. I believe this is a buying opportunity rather than a time to worry because the economy appears to be headed for a soft landing. Could the market be ahead of itself until all the positive news soft landing rate cuts has already been priced in? The worry of a significant market top is that. However, there are 2 factors to consider. The advanced decline line reached its highest point ever, indicating that there is no chance of a market top. Additionally, small cap stocks are trading at 10 times forward earnings, which has never historically resulted in a significant market high. On small caps, you made a significant decision. Do you still think they can increase by 50% this year? Yes, I still think so. Earnings have been solid despite little caps getting caught in the mud. Small cap profits are predicted to increase by 40% in Q3 after increasing by 19% in Q2. Their PE is still only 10.7 times forward earnings, and the fundamentals are improving. In less than 20 trading days, tiny caps saw a 27% move last year. Small caps will be approved once the market is certain that the Fed will implement rate cuts and that a soft landing is imminent. By investing in both Nvidia and Broadcom, you somewhat hedged. Discuss the deals you made. With the options market pointing to a 9% increase, we had a solid thesis last week that Nvidia would be erratic. However, You never know if it will rise or fall. We wrote a covered call with a 1-week expiration because Broadcom is also predicted to move 8 to 9%, which generated a 60% annualized premium. We generated $2.25 for Nvidia and closed it out yesterday. We placed another call with Broadcom and generated $1.73. This worked out well because it hedged around 20% of the decrease in those stocks today. So you're more of a buy this market person than a beware of it person. Yes, but today we made no purchases. The first week following the holidays was a shorter week with a higher volume. We wanted to see the jobs report and give things time to calm down. There is doubt about whether the Fed would lower rates by 25 or 50 basis points, and the market sell-off appears to be more of a growth issue than a recession issue. I would definitely buy the decline since Broadcom is back to where it was in early August and Nvidia is coming closer. You intend to purchase the dip, but you took no action today. What is your overarching strategy going ahead, particularly while the market processes all of this uncertainty? Indeed, we made no purchases today. After such a turbulent time, it's wise to exercise patience. The market is still attempting to comprehend the implications of the just-released jobs report for Fed policy and GDP. The sell-off, in my opinion, is more about growth issues than a potential recession. It's unclear if the Fed will cut by 25 or 50 basis points, but that uncertainty also offers chances, particularly for equities like Broadcom and Nvidia that are returning to their pre-August levels following a significant sell-off. I believe the market will eventually find a rhythm, and those buying chances will begin to show up until the Fed gives us a better signal or more specific economic data. At that point, we'll try to intervene more forcefully. For the time being, it's about observing how the larger market and particularly tech responds to all of these variables. Would you still give tech priority over other industries in light of its recent volatility and valuation concerns? Yes, I still think that if you want to be in it in the long run, that's where you want to be. These companies have solid fundamentals, so even though there can be some short-term volatility and re-rating, I don't think you should give up on the industry. Much of this is due to noise and seasonality, and it's crucial to keep in mind that interest rates are expected to decline rather than rise in the current climate because they have lower borrowing costs and greater potential for future revenues. Tech and growth stocks have historically benefited from this. However, I believe there are strong arguments for branching out into different fields. For instance, small caps are currently quite valuable, with many of them trading at incredibly low multiples. Although they have lagged behind in current market boom, profit growth is present, and I believe small caps might move swiftly once investors' confidence returns. Therefore, even if I'm optimistic about technology, I also believe that other industries have room to flourish. Is this a more selective market potential, in your opinion? It seems selective to me. At the moment, we are in a stock picker's market. Purchasing the index alone will not guarantee widespread benefits. You must choose wisely where to invest because some industries and businesses will do better than others. Small caps, for instance, appear appealing due to their extremely low values and, in my opinion, a margin of safety. However, with small capitals, you still need to exercise discretion. Not all businesses will gain the same amount from rate reductions or a soft landing. Similar to this, you must understand that not all tech stocks will perform similarly, even though I believe the long-term prospects are good. Some of them have short-term extended values,